Hello there. Today is Monday. Today I went to the lawyers to sign all the paperwork for my house closing that's happening on Thursday, and part of that was signing a bunch of mortgage documents. And they were talking about how there's going to be an interest adjustment payment due on September 1st, and they didn't tell me how much that was going to be. So I have asked my mortgage broker, let's be clear. I have asked what the amount is going to be. I'm not just going to calculate it, but I'm also going to calculate it because I want to know like now. I'm being impatient about it basically. So I created myself an amortization schedule for the mortgage. And so what that means is, let's back up. Amortization is the paying off, you're paying off a debt over a long period of time. And so you would create an amortization schedule because you would want to know how much of each payment is interest and how much is principal. So if you have a fixed payment on your mortgage, for example, then the piece of it that you're paying that's interest would change as you pay down the principal, because the interest is obviously based on the amount that's owing. So in the first payment, if you're paying off a mortgage, say your payment's like $2,000, maybe your interest amount that you're actually paying is like $1,500 because you've just started this mortgage and only $500 of it is actually going to the principal. And then the next payment, maybe it's like $1,450 or something like that. Like every payment, it goes down a little bit. And so if you want to be able to track the interest piece as you're going, so you know how much how much you've paid in interest over like so far, then you need to create yourself an amortization schedule. To be clear though, the mortgage companies do send you a statement at the very end of the year to say like, here's how much principal and how much interest you've paid for the calendar year. So if you just want it all at once at the end of the year, you can just wait for that. But I, being who I am and being an accountant, have decided that's not good enough for me. I want to know every payment, what the interest portion is, so that I can account for it correctly as it comes out of the bank account. And so I created this schedule, and basically what the schedule is it lays out each line in this schedule lays out the exact amount of principal and of interest that I'm paying in every payment. So when I go to record it in my accounting software, I can split it out between like the $1,300 in interest that I'm paying and the like $500 in principal that I'm paying. And then my interest expense is always correct and my loan balance amount is always correct because I'm not applying the full mortgage payment to the loan balance because I'm not paying down the principal on it. At the end of the year, even if you're tracking this month by month and you've created your own schedule, at the end of the year, it's still a really, really good idea to compare against the statement that you get from the mortgage company. Just make sure that the interest that you've paid matches what they've said. Hopefully it's really, really close. It's probably not going to be exact just because these kinds of things tend to differ between the ones that we create and what the actual ones from the mortgage company are, but it's very, very small. So at the end of the year we just post an adjustment to make it balance basically. So this kind of thing, although I've used the example of my mortgage, this is something that we do in business as well. If you have bought an asset like a piece of equipment, or maybe you have a mortgage on a building or something like that, we would create the amortization schedule so that we know every payment, how much should be reported as interest and how much should be reported as principal, so that when you run an income statement, you have an accurate idea of how much it costs to run the business at any given point. So if you're buying a really large asset, I shouldn't say a really large asset. If you're buying an asset that you financed, then I think it's important to have an amortization schedule that you've created. It sounds really fancy, an amortization schedule, but they are generated basically by Excel. Like you can download a template for it and you just like type in your information and it generates the schedule. So gone are the days of having to do it pen and paper like I did in school. Although I actually kind of like doing amortization schedules in school because they just like like you go through the exercise and you get to the end and it all balances and you get to zero and you're like, yeah, zero. Probably just me on that one. But yeah, amortization schedules can be super useful for your business. So if you've got an asset that you financed, I recommend creating one just so you can have it sort of like a roadmap for your interest expense over the next however many years that you finance this thing. If you have any questions about amortization schedules, how you might create one or why you'd want to use one, or if you have a specific asset that you're like, hey, I don't know, like, should I make one or not? I usually recommend just make one because they're super simple in Excel. But I'm happy to chat with you. So leave your questions, comments, any of that in the comments, and I'm going to answer them. I'll talk to you about it. I hope you're doing well, and I'll see you tomorrow.